Hi, everyone, and welcome to this week's episode of Blockchain Today, where we discuss all of the new and happening topics in the blockchain industry. And we start off with a new segment today where we explore practical applications for blockchain technology, and we call it Agenda Adoption. In this segment, we look at how Bitcoin is finding use as a hedge for global crisis. Throughout its short history, Bitcoin has been seen as anything but centralized, sovereign, and censorable. The crypto asset was created by a pseudonymous individual, is secured by a global group of miners, and is backed by no government, traditional finance system, or common entity. And as a result, many have looked to Bitcoin and its brethren, other digital assets, as much as a needed escape hatch from fiat and government overreach. Indeed, BTC was released in the wake and seemingly as a result of the 2008 Great Depression, and many have since flocked to the cryptocurrency, are staunch anti establishment proponents. Cynics of the theory remark that BTC is too nascent to be used as a proper store of value, citing the periods of volatility, especially the downturns, as a perfect case in point. Regardless, a massive cryptocurrency firm recently laid out why these naysayers may be wrong in their postulation. Bitcoin as a macroeconomic hedge. Grayscale's industry famous research department recently released a report titled Hedging Global Liquidity Risk with Bitcoin. In it, the firm explained how the leading cryptocurrency is becoming used as a hedge in financial crisis and periods of geopolitical turmoil. More specifically, the crypto investment firm looked into how the asset can be used during bouts in which there is high liquidity risk, the risk of a real decline in wealth resulting from an imbalance in the amount of money and credit relative to the debt in a given economy. Back to this point, Grayscale looks at three primary facets of Bitcoin's existence: its store of value, spending viability, and its growth possibility. First, as the company has characteristics, BTC can act and has acted as a better store of value than gold. Unlike the metal, crypto is mathematically scarce, capped at 21 million units. Bitcoin is decentralized and verifiable through the internet. Bitcoin is portable and divisible through digital technologies and is unconfiscatable. Gold, on the other hand, has a limited supply, centralization risk, an inability to be easily divided and moved around, and corners around its purity. The chart below from Grayscale sums up the argument really well. Secondly, Grayscale perpetuates that due to having similar properties to physical cash, Bitcoin will retain a solid value proposition amid its liquidity crisis. They look to recent adoption by Whole Foods, AT&T, Overstock.com, Microsoft, Expedia, PayPal, and Dell to collaborate their claim. Thirdly, they remark that the potential that Bitcoin technologies have to grow and create a value will only stimulate demand further, which should mitigate most, if not all, negative effects in any downturn in global markets. So, as these characteristics are helping Bitcoin hold true in the current geopolitical stage, well, yes, and it already has been for a while. Grayscale looks to the fact that during Brexit or Greece's debt-fueled financial crisis in 2015, China's market collapse in 2015-2016, Brexit, a short period of growth worries for the US, and the recent trade war debacle, Bitcoin has done rather well for itself. Grayscale says, while it is still very early in Bitcoin's life cycle as an investable asset, we have identified evidence supporting the notion that it can serve as a hedge in a global liquidity crisis, particularly those that result in subsequent currency devaluations. In fact, some have argued that the recent political tussle between China and the US is what has contributed greatly to the recent rally in the Bitcoin price, with some arguing that Chinese traders and others in Asia have fled to Bitcoin from traditional stocks to deter most downside risk. Indeed, this strength is why many love Bitcoin. In fact, Delphi Digital, a New York-based crypto research group, recently pointed out that BTC is absolutely lapping every other asset, even the more risky, high-return blue chips and the venture-backed Silicon Valley darlings that have begun to trade on public markets. So let us know what you think about this new segment, and we will move on to the news now, and we start with Facebook's Libra. If you don't know about what it is, the currency is known as Libra, which the social network says it has no special role in governing and will manage equally with a group of big companies. Experts have branded the move a dangerous power grab that marks Facebook's most invasive form of surveillance yet. So far, Facebook has enlisted 28 firms, including Spotify and Uber, who had each invested a minimum of £8 million to be a founding member of the Libra Association, an independent non-for-profit membership organization. It wants to attract 100 businesses in time for launch, which is aiming for the first half of 2020. Libra is supported by a reserve of the world's best assets and the world's most trusted central banks, who gave the cryptocurrency general cautious support, according to David Marcus, who started exploring blockchain at Facebook a year ago. Libra holds the potential to provide billions of people around the world the access to a more inclusive, more open, and a better financial ecosystem, he explained. The social network is hoping that its collaborative approach can ease volatility concerns of existing blockchains and cryptocurrencies. Facebook will operate its own digital wallet for people to spend Libra, known as the Calibra wallet, which will be available in WhatsApp, Facebook Messenger, and as a standalone app. Users will be able to send money to each other initially at low to no cost, the social network said. Eventually, it ends to open the Calibra wallet up to additional services so that people can pay bills, buy goods by scanning a code, or accessing public transport. Account information from Calibra will not be shared with Facebook to improve things like ad targeting, except for limited cases where this data may be shared to keep people safe, comply with the law, and provide basic functionality to people who use Calibra, the social network says. Now, this part is very important here because they have pretty much said that, yeah, we need the data so that we can improve the basic functionality of the product that we're giving. And that's pretty much what they did before. They wanted to say that, hey, look, yeah, we want to make your experience better. We want to show you more relevant things. So you can see why people are worried about the system as a surveillance model. But let's continue. Libra is open source, meaning anyone will be able to launch their own digital wallet and include the currency. As a founding member of the Libra network, Vodafone has said that it will extend its commitment to digital and financial inclusion by supporting the creation of a new global currency and encouraging a wide range of innovative financial services to be deployed through its open source platform. This was said by Stefano Paresi, the group director of product and services. He has also added that this has the potential to be truly transformative and will benefit those who have never used or are struggling to access financial services around the world. So like it or hate it, Libra is gaining traction and will be interesting to see where it goes. Now we move on to the news about supply chain space, and we'll give you a holistic update on the same. So let's just get started with IBM and what they've been doing. IBM has been one of the most active companies around supply chain visibility and has put together at least 2 consortium of companies, as well as created an incubator that supports even more companies that are creating blockchain solutions that address supply chain visibility. Of note, the IBM Food Trust Blockchain Consortium, which includes companies like Unilever and Nestle on the supplier side and Albertsons and Walmart on the retailer side. TradeLens, a joint IBM consortium designed to tackle some of the thornier issues around import-export. And here is the list of top blockchain companies that are joining IBM's accelerator up on your screen. There are some retailers who are going their own way in investing and supplying visibility that leverages blockchain, including Carrefour, which has already been using blockchain to track chicken and is expanding to include Italian lemons and oranges as well as milk. On the supply chain side, Starbucks has partnered with Microsoft to track packaged coffee that we have covered extensively in one of our podcasts below that I have linked down in the description, and has additionally turned that around to an app that consumers can use to trace the origins of the package they're buying. And Bumblebee Foods has partnered with SAP to track seafood in its supply chain. Some startup tech vendors, including Connect Food, one of IBM's accelerator companies, and OmniChain, are putting together packaged supply chain solutions that companies can buy, not consortium, and ideally provide a more off-the-shelf approach to initiatives like the ones that Starbucks, Carrefour, and Bumblebee are undertaking. Now we move on to the anti-counterfeit supply chain part of it, where LVMH, the parent company of a slew of luxury brands that often fight counterfeits in the market, has taken the lead in using blockchain in their efforts, partnering with Microsoft to launch Aura, anti-counterfeiting initiative. LVMH is focusing first on Louis Vuitton's fashion and Christian Dior's perfumes and hopes to provide what is basically a lasting certificate of authenticity for every item, which makes it possible to verify that the item was actually manufactured by the brand in a way that assists the initial purchase but also the resale in the market. This is an area that has also been active from a very startup perspective, with new tech vendors organizing to provide white label solutions for any brand to protect the authenticity of their products. Linfinity is one such company and Simply Brand is another one. They work by providing technology that enables companies to basically issue certificates of authenticity for their products and attach them to individual items, often either using an NFC chip or a 2D barcode embedded in the packaging or as a label to connect the item to the digital certificate. And finally, we have the IoT or RFID segment, where while RFID in supply chain is nothing new, IoT brings a new dimension to it, with the inclusion of sensor data like temperature, vibration, or G forces to measure if something was dropped. The problem with IoT and blockchain is that blockchain is not very efficient in handling transactions, and without sensor data, IoT generates a lot of data. There is a lot of interest in solving this problem because IoT generated data is the kind of data that's easier to trust than manually entered data and can provide enormous depth to supply chain visibility tracking if the volumes can be managed. One consortium working on this is the Auburn University CHIP initiative, where IBM's Food Trust focuses on consumer packaged goods. Auburn focuses much more on fashion supply chain, which makes sense because fashion has done a lot more with RFID than food has, even when it seems like IoT-based sensor data might ultimately be more valuable for food. If CHIP can prove out that RFID and blockchain go together, well, it won't be that much of a first step to expand it into a sensor-generated data as well. So as you can see, the applications are enormous, and we can't wait to keep bringing you more and more news about blockchain technology. So that's all for today, folks. And if you like this video, then please like and subscribe and let us know in the comments down if there are any topics that you want us to cover in particular. And we'll see you guys next week. Bye-bye.